A very good morning. You're watching India Market Open. It's Tuesday and the world isn't looking great in terms of equity markets. Our market's struggling. Niraj, 24,800 has been breached again on the downside.
Yeah, and the broader market seems to be the bigger pain, right? It just seems that finally everybody's saying that large caps will weather the storm better. Turning out to be true, Samina.
Weather the storm, I don't know, but yeah, you're right. The broader markets, the pain is obvious. And some of those large caps, right, the reaction to their earnings has been very, very heartbreaking, I'd say. I mean, look at the Tata Consumers yesterday, 9% cut on weak earnings. So there is pain, and the pain seems to be very obvious across market cap. Of course, the large cap space looking slightly better placed than the broader markets, but not to say that we're even holding on to levels that were significant in terms of last week's trade. Remember, last week 24,800 was a very clear sort of support for the market, which has again gotten taken out. We've moved very gradually from 25,250 to 24,800 in the last 2 weeks. This morning, the not so good news is that global markets aren't looking great either. But again, what we've been seeing is decoupling between US equity markets and Indian markets. Implied Nifty for a change is indicating to a marginally positive start. But let's tell you what happened on Wall Street. They've had a good run. They've been on record highs on Friday. So come Monday, those markets spent some time consolidating after a very sharp 6-week rally that those equity markets have seen. The Dow and the Nasdaq retreated just a tad bit. Investors, though, remember, in those markets continue to track earnings. 1/5 of the S&P 500 earnings are being reported as we speak this week. 83% of companies that reported numbers so far have actually beaten street expectations. So while some of our earnings or most of our earnings back home have been disappointing, it seems like US investors are in for a positive surprise where earnings have largely beaten street expectations. Well, Asian markets, on the other hand, are also trading lower, tracking US Qs. Remember, in Asia, there's no major Q that's lined up this week. You had that big stimulus coming in from China, and Hong Kong and China now, of course, muted after that big reaction that was seen on those markets, post at over $100 billion stimulus coming in from the Chinese regulator. Bonds is what caught my attention. I mean, look at the way bonds have recovered in trade on overnight trade. The 10-year has jumped to 4.17. It's a 12-week high. Now, it's very mixed, right? Bonds usually move up on anticipation of a slower rate cut. There was some comments coming in from a couple of Fed reps, and I'll just quote what Neil Kashkari has said, and this could be one reason that gave a little bit of impetus to where the bonds and the dollar market was trading. Neil Kashkari has said that rates could be higher than it has been in the past. Dallas Federal Reserve President Lori Logan has also said that she supports the current move to lowering interest rates, but the patient approach will be needed. Yields, of course, reacted to that positively. You saw a big spike coming in on the 10-year, jumping to a 12-week high. Crude, after a 7% fall last week, is gathering some steam, up nearly 2%, could be back on the way the geopolitical tension continues to rise, and the hopes that China's stimulus will actually help the demand picture there. You also had Saudi Aramco CEO who indicated that he was still fairly bullish on China's oil demand despite the recent cues and signs that are coming in from that market. Gold has taken a breather just like equities, hit $2,700 an ounce, consolidating around those levels. Spot silver, though, is what's catching my attention. Very, very sharp rally on silver. Normally what we've seen is that gold and silver move in tandem, but the last leg of rally on gold was not reflected on silver. So you did see a catch-up rally over the last 2 days on silver, with record highs being hit. In fact, silver trades at its highs of 2012 now. So silver looking better placed than gold in commodities. Oil seeing a little bit of a pickup. Equity markets globally taking a breather, and bond yields spiking is what we have this morning. So Niraj, not much in terms of a handover from world markets, but in any case, it hasn't been mattering too much in the last few days because in some ways we've decoupled, at least in October.
Unfortunately, for the wrong reasons this time around relative to what's happened. But yeah, I mean, absolutely not too much to add to that. I mean, just look at the broader market pain, and if you just pull up the, let's say, a 1-month performance of the Nifty versus the 1-month performance of the mid cap versus the small cap. So the 1-month performance of the Nifty mid cap, and that's a downtick there, and a quite a big one relative to the Nifty. That's the point I'm trying to make. For the small caps, even more so. 1 month performance 2.65%, and look at the last few days or last 3 days, the perceptible slide in the mid caps and the small caps, and now ingrain that or compare that with what's happening in the Nifty. Just pull up the Nifty chart for the last 1 month, or there's a comparative chart as well, and you will see that the last few days the mid caps and the small cap performance has been very, very sharp. So therein lies the problem for the markets. I think what the HDFC Bank performance of yesterday, or the resilience in IT, even at times when the numbers haven't been the best, probably shows that large caps may weather the pain better. And therefore, that is something that people should definitely keep in mind on individual portfolios as well. Mutual fund, flexi cap funds will do the balancing very well. A lot of them are sitting on cash and large caps any which ways. But I think retail is sitting on a large degree of mid caps and small caps, and you've got to be careful. I mean, just look at what HFCL, much storied, much spoken about. The stock in the last 10 days has come off from like 168 to 124 or thereabouts on trade yesterday. And we'll talk about that in a bit today as well because of the results. And that the other thing is cement, right? You look at pockets. The interesting thing out there, Samina, is that it seems to be finding limited upside triggers, but because such bad numbers were penciled in, that there's not a dramatic sell-off in the whole space, despite the howler numbers coming from Dalmia Bharat or Ultratech and the way it's performed yesterday. Estimates were lower. They've come in even lower than the estimated numbers. And therefore, I don't know if there is an upside. The reason I bring it up is because 2 days ago, of the last 7 days, we've seen commentary from both Morgan Stanley and I think Jefferies or Macquarie talking about how they want to go long on cement because the pain is priced in. Doesn't seem to be finding too many upside triggers here.
And Citi, of course, has put out a report. They've gone overweight in Ultratech yesterday, and that could explain why you saw that rally. But you were talking about how mid and small cap funds continue to see an inflow, and data from AMFI has shown that small and mid cap funds have once again seen record inflows in the period from April to September, clocking in 30,350 crores. So that is a significant sum of money going into the broader market universe, despite the fact that that universe has been correcting quite sharply. Also, what you want to remember is that the regulator has been constantly sending out warnings that there could be a little bit of a bubble across the broader markets, but that hasn't, derailed any of the inflows that the broader markets have witnessed. Talking about what is happening on the index, and Niraj, I think this is what's beginning to worry me now. Last week on Monday, when we opened trade, the Nifty was at 25,177. We were slightly concerned that 25,250 was getting taken out. 5 days out, we are sub 24,800, which was a very far away support. And also the fact remains that the F&O activity was heightened at 25,000 and 25,250. So the range every week seems to be moving about 200, 300 points low, and that could be something to be concerned about. The WIX saw quite a jump in trade yesterday, and the broader market universe. You get stocks like a PNC Infratech that sold off so very sharply in trade. I know that there has been some disappointing news on back of those orders that they'd won, and that had led to the rally, but that gave up pretty much all of it in trade. But very quickly, a quick recap of what happened yesterday. Mid-cap index, remember, is down 5% this month. So what you want to remember is yesterday's sell-off was 1.5%, but in the last 1 month, the mid-cap index is seeing a cut of 5%. 36 of the Nifty 50 stocks ended lower in trade yesterday, and 350 of the 500 Nifty stocks have ended in the red in trade yesterday. Bank Nifty has been better placed, along with IT has been providing some support to the Nifty, largely on back of the way some of the private sector banks like HDFC have been doing. But unfortunately, in yesterday's day of trade, Bank Nifty as well closed sub 52,000. Tata Consumer, like I said, declined sharply in trade. It was down 9% at some point, recovered a little bit on back of earnings that were a huge disappointment. Kotak, BPCL, Bajaj, Finserv all experienced cuts of over 3%. On the upside, auto gave the market some support. That was because they've had a really rough last 2 weeks. So there was a little bit of a consolidation, technical bounce back that auto counters witnessed. Bajaj Auto, HDFC, Asian Paints, M&M and Eicher Motors ended the day on a positive note. In fact, barring auto, every other sector has gone home with cuts in trade yesterday. PNC Infra, India Mart, in fact, India Mart technically was looking very strong. But what happened is the markets opened and the counter was down with a 20% cut. On the other hand, Amber and Tejas did well. Both those counters gained in trade yesterday. FIs remain net sellers, and that's a worry. They've sold 2,200 on Monday, and they've sold 82,400 crores worth of Indian equity in October alone. Niraj, as we go in today, implied Nifty is indicating to a flat start. I'm still hopeful. I do still feel like 24,800 is a level that the bulls will try and reclaim in today's day of trade.
Yeah. I mean, I, in some sense, that 750, 800 level seems to be where the maximum support is. So it'll be interesting to see if that happens. But, Samina, big listing day as well. I know we're going to talk about it, but this is the big one. And there's a nominal unknown today, but that notwithstanding, the fall in premiums or the gaining numbers make you wonder if the listing or the big listing will be a disappointment, if you will.
You know, so on Friday, there was a 3.5% discount to the upper band of the subscription price. This morning, though, of course, grey market premium is not supposed to be taken too seriously. So it's not a regularized market in that sense, but is now at a 5% premium. So there's a little bit of a gap up that we're expecting. But the large verdict on this one is that if you are buying it, you shouldn't be looking at listing gains per se. This is a stock that probably will be better fitted if you're a long-term investor. But what's also interesting is while this is India's largest listing, investors across the world and institutions across the world are actually tracking the Hyundai listing this morning. Who knows, there may be other MNCs who may consider listing in India depending on the success of Hyundai. But Bank Nifty as well, Niraj. HDFC has impressed the street yesterday. Kotak disappointed, RBL disappointed. So lots of pulls and pressures there too. We did close up 52,000 on Bank Nifty, but I think a pullback on recovery on Bank Nifty cannot be ruled out. So a little bit of support from there may just be some hope for the street.
Yeah, I mean, banks kind of holding out. And Samina, just before you get to stocks, it'll be really interesting to see if Kotak kind of recovers, because Morgan Stanley is calling it an opportunity to add. And maybe some of the larger banks might actually do well, because the NPA problem will hit them a lot lesser than smaller books. So it could be interesting. Yeah,
that should be good to see how banks perform. But today, of course, you want to continue tracking earnings. There's a whole barrage of earnings that has been reported between yesterday close and, of course, this morning. I'll highlight a few, and then, of course, we'll go into the other stocks that Niraj is also tracking in trade. But the first one on my list is Bajaj Housing Finance. If we can quickly pull that up and take a look at how the stock is going to react in trade depending on the earnings it's posted. So if I get that up, their net interest income was up 12.9% at 713 crores. Revenues from operation have also gone up 26%. Net profit is up 21%. Disbursements, though, have declined to 12,104. So you want to watch out for this one. Numbers are largely in line with earnings. 4% margin business. Credit cost was also controlled in the range of 14 to 17 basis points. Management, of course, in their commentary has talked about competition being strong, but 24% growth, they said, at an average is very, very doable for them going ahead as well. But of course, the caveat is that there is competition. They're probably trying to keep expectations, sort of controlled. Maybe under-promise, over-deliver could be a strategy that they're looking at. But institutions aren't too pleased with that commentary. But the numbers have meet and street expectations in every way. Apart from that, we have a few more counters that reported earnings. And this one has, like every other peer in the industry, a competitor in this space. 361 WAM has reported solid numbers. Profits have surged 33%. Net profit is also, is up 33%, and revenues are up 38%. So very, very good numbers coming in from 361 WAM, just like its peers like the Anand Rathi, which managed to report 30% plus growth in the quarter. The stock could be a big gainer in early trade. ATM investments, and I'm not sure what has impacted them so badly this quarter, but their profits have declined substantially. 57% drop in profits, coming in at 842 crores versus 1,939 crores in the same quarter last year. Revenues have declined 50% to 1,092 versus 2,151. So those two numbers slightly, in fact, actually, Bajaj Housing Finance is a neutral. 360 WAM is a big positive. ATM investments, a huge disappointment, Niraj.
Yeah, it'll be interesting to see how some of these react in the session today for sure. I was looking at, what are the three stocks that I would want to talk about? All of them smaller names, if you will. Starting off with City Union Bank. The NII is up 8% at 582 crores versus 538 crores. Gross NPAs on a quarter-on-quarter basis have improved, and the net profit at 285 crores is just about in line or slightly higher than the estimated 272 crores. Now, the quarter is good. The brokerages are very constructive on these numbers. So Macquarie, for example, I'm using that as an example, is saying that it's an outperform rating with a target price of 185. They are saying that the growth engine finally turns on when it comes to City Union Bank. The risk reward, they're saying, it looks favorable given the potential growth and the ROA trajectory. I think even Investec, for example, has said positive things about the City Union Bank numbers. So do watch out for this one. I thought Balu Forge was interesting. I mean, this is at a point of time when commodity prices have shot up for a auto anch company and a forging company to do what it has done. Revenues up 60%, which is impressive by itself. And then comes the added layer of the margin performance. 763 basis points higher at 29.5 versus 21.87. Some bit of operating leverage would have, I reckon, come out here. And the net profit up 108% at 48 crores versus 23 crores. This one promises to be a rank outperformer in the session today. So do watch out for this one. And EPACK Durable from amongst the top three names. And then there are some more that both Samina and me will talk about. But EPACK Durable, I thought the announcement is interesting, that they've entered into an agreement with Hisense to manufacture air conditioners and home appliances in India for the world. So make in India, make for the world, global partnership. It's a small stock, but who knows, 3,500 crores auto EMS company could see a bit of an uptick today. So top three names on my list are City Union Bank, Balu Forge, and EPACK. What else, Samina? What else do you like?
Jan, I don't like too much. Jana Small Finance Bank, very disappointing numbers coming there. We'll be talking to the management shortly and understand what's gone wrong for them this quarter. But their profits are down 21%. Net interest income is higher by 13%. Provisioning has jumped up to 210 crores versus 160. Gross NPAs have risen and so have net NPAs. So Jana Small Finance Bank is a very clear thumbs down in terms of earnings. The stock already saw a 4% cut in trade yesterday. The other few that I have is Cyient DLM, small company, but worth a mention. Profits grew 5%. Revenues were up 34%. EBITDA has surged and margins have improved to about 8.1 versus 8%. Supreme Petchem is another company that reported profits have grown, revenues have risen, EBITDA has jumped, margins have remained flat. So Supreme Petchem as well, not a bad set of earnings to say the least. Don't know whether you want to talk about Mahindra Logistics, but they've managed to reduce their loss, their revenues grown, EBITDA has jumped, margins have improved. And a bunch of other smaller ones too that have reported earnings, but a quick update which we've missed. Lemon Tree Hotels, which had got into the habit of announcing a license agreement over properties pretty much every single day in September, is back, and this time around they've signed a license agreement for a property of 72 rooms in Karnataka. So there's some good news for Lemon Tree. The stock, of course, like every other, or like most other broader market stocks, declined in trade yesterday. This morning, though, it could see some bit of an uptick, Niraj.
Yep. Watch out for some of these as well. The other one that I thought was a bit of a disappointment was HFCL. For a much storied stock, and like I said, has come off a little bit or quite a bit from the highs. Revenues were down 1.62%, but margins expanded. So a bit of a mixed bag here. And profit after tax up just a mere 4.28%. There's a lot of promise here, a lot of order promise. They are the only ones which supply to the EU region, but not showing in the numbers, unfortunately. So who knows, may see a bit of a corrective move in the session today. I would reckon it could correct. Watch out for Bhansali Engineering Polymers as well, a bit of a margin disappointment. 376 basis points lower margins at 14.55 versus 18.31. And then just before we get to stocks, some brokerage calls. Samina might have a few, but here's the top three that stood out for me today. BofA has downgraded Sapphire Foods to an underperform from a neutral. They've cut the target price to 330 from 336. So watch out for Sapphire Foods. Bring up that stock as well for a moment if you can. And we should try and bring up Sapphire Foods at 345. And Citi said that PB Fintech is likely to be the key beneficiary of any significant rise in new policy sales. Watch out for PB Fintech. And Morgan Stanley is saying that banking will go through material challenges on profitability, and Kotak will stand out positively. So therefore, this is one more that you might want to watch out for. Top 2 or 3 names on my list.
Yeah, so I think that pretty much covers all the earnings, all the stocks that we have. You've got a barrage of earnings that will come out today. So you've got Bajaj Finance, you have Zomato, Paytm, Indus Tower, Coforge, ICICI Pru, M&M Financial Services, Aditya Birla Real Estate, Adani Energy, Adani Green, Amber Enterprise, which was your top gainer in trade yesterday, will report numbers, Chennai Petroleum, IFL Securities, and ICICI Securities. So lots and lots of companies that the markets will be responding to in terms of earnings. In terms of the F&O ban, definitely worth a mention is India Mart. And the reason I mention this is because the stock tanked in trade yesterday, 20% lower. Now, of course, moved into an F&O ban. Manappuram Finance, Piramal, Aarti Industries, Bandhan Bank, Chambal Fertilizers seems to spend more time in the F&O ban than outside it. GNFC Granules, Hindustan Copper, similar to Chambal. IDFC First, L&T Finance, PNB, RBL, and SAIL have all moved into an F&O ban. This all comes in after the big sell-off. Some of these counters saw on large volumes in trade yesterday. But like we said, the stock of the morning could be Bajaj Housing Finance. They reported their earnings, and Harsh is standing by with what's worked for them and what brokerages seem to believe. Harsh, good set of numbers, largely in line with what we were expecting. Management cognizant of the fact that competition is getting strong, but they seem quite confident, don't they?
They do, Samina, but so an inline set, but needs to be taken with some perspective. First off, with regard to margins, they're expecting margins to be steady, but when you're looking at credit costs, those have really been muted, and which is a positive, of course. So that positive surprise likely to unwind and normalize. 14 to 17 bips is where they expect the credit cost to actually be at, and therefore some bit of normalization on that front should start to impact numbers, especially profitability. The other one which has done well is the other income, which has risen very sharply. You're looking at a 30% rise on a year-on-year basis. 45% rise on a year-on-year basis where other income is concerned, and therefore that one also bumping up profitability, which is again quite a positive in that sense. Asset quality, on the other hand, remaining absolutely solid, below 0.3% in terms of GNPA, 0.12% in terms of NNPA, just a 1 bip increase on both, which is 0.01% increase in this environment. Clearly a positive, clearly a standout. But credit cost normalization as well as other income tapering could likely keep a lid on profitability going forward, and therefore HSBC has trimmed some of its EPS estimates, target price being 110, which HSBC has given. So clearly a downside of nearly 20% from here. But they believe that earnings should likely start to reduce in terms of the percentage growth on EPS. So keep your eye out on this one. While inline set of numbers, commentary being slightly on the muted side. Competition is strong, of course. They've guided for that, and therefore growth should likely be capped, is also what they seem to suggest as part of the call.
Okay. Bajaj Housing, watch out for this one as well, from amongst the large ones that came out yesterday. By the way, this week is full of very strong numbers, so bear that in mind. We may think about this thing, but it's a big Zomato meet today, and then a clutch of numbers coming out. So while we didn't have too much post-market hours yesterday, the week is interesting. By the way, the gas stocks, and I think IGL, MGL, etc. have been in focus now for the last 2 or 3 days, but Morgan Stanley in the latest note has signaled strong preferences for key players like IGL, ONGC, GAIL, and Oil India. Mika Johnson with more on this. Mika, good morning. What is Morgan Stanley saying, and is it in line with what some of the other brokerages have said in the last 2 days?
It's actually not. What we've seen brokerages come out with is how lower APM gas allocation is negative for city gas companies. What Morgan Stanley is saying that they prefer Indraprastha Gas, ONGC, GAIL India and Oil India in terms of the gas industry, and the lower gas allocation for the CNG segment will be in favor of gas producers. These are your companies like ONGC and Oil India. Now APM gas allocation is basically something that ONGC and Oil India were providing with city gas distribution companies like IGL, MGL and GGL for their gas sourcing. This actually helped them maintain lower operating costs. But now this allocation has been cut by 17 to 20% as per companies and brokerages. And Morgan Stanley expects this gas allocation to near almost zero in the next 5 years. They see the city gas distribution companies as simply energy transition plays that are supporting the natural gas penetration to increase further from 6% currently. Now we did see IGL, MGL, GGL correct. IGL, MGL correct 10 to 13% on Friday after the news came out on Thursday. But what Morgan Stanley believes is that they would buy into the correction in Indraprastha Gas specifically, as well as companies in the gas value chain. And when you talk about, the companies have seen re-rating over the past few months. We've seen IGL get downgraded due to the EV penetration risk. But we now have analyst notes coming out that, this EV risk is overplayed, and they expect the sector to continue to re-rate, and it's key to see how the stocks move from here.
Okay, Mihika. So Mihika, net, sorry, are brokers now turning constructive on, for example, IGL, MGL, Gujarat Gas, or is it only restricted to maybe an IGL?
So what I've noticed is they were not very bearish on MGL and GGL to start with, but they had gone bearish with IGL. But the few notes that we've seen coming in the last 2-3 months, they've stated how the EV risk was overplayed, and despite the EV penetration in buses, the CNG volumes still hold for key areas, and because IGL is expanding its geographical areas, the new volumes coming through will support growth going ahead. So we do see analysts kind of turning bullish towards IGL as well.
Okay, Mihika, fine. Thanks so much. So last 2-3 months, okay, but the last 2-3 days, very important since the ruling came out as well, and Mihika getting us those updates. Okay, well, as we hit that break maybe, hear out veteran investor Mark Mobius, who spoke about his enthusiasm for Indian markets and how India has outperformed the US markets. The founder of Mobius Capital Partners talking about the India story in a conversation with Ramesh Damani at the NDTV World Summit.
I don't look at PE the way I used to. In the past, everybody was looking at PE. And I found that this was not a very good metric because the E of the P, the E was always backward looking. They of course, they tried to make projections of the E, but they really didn't do it very well, and it was not very accurate. So the metric that I look at now is return on capital, return on equity. This metric is very, very important. Because interestingly enough, the other metric we look at is debt equity. And if you have a high return on capital, you usually have a very low
return on equity.
Because you're generating cash. So I look at that, and I also look, of course, at earnings growth. But probably the most important element in all this is the quality of the management. What kind of people are you dealing with? Which is why I travel a lot, and to meet managements, to see who they are, what they look like. Of course, you can be misled.
But you talked about long-term longevity. But for the last 10 years, the Dow and the S&P 500 have outperformed emerging markets. So is emerging markets still a place to be?
Actually, if you look closely, you'll find that India has outperformed the US market, S&P. And recently, with the resurgence of China, the emerging market, MSCI Emerging Market Index, is outperforming the US market. So the problem with emerging countries or emerging markets is that they're so varied. You lump them into one big pot, and of course the outliers tend to drag down the rest. And you've seen that in the case of China recently. But the bottom line is that emerging countries are still, on average, growing at double the rate of the developed countries. Now, if a country is growing at double the rate of another country, that stock market is going to do better over the long term.
Mark, though, in your experience, do you feel there's a relationship between GDP growth and the stock market? Do they always move in the same direction?
They won't move in the same direction, but the general trajectory will be that way. If you have a high growth country, you're going to get high growth companies and therefore high growth market.
But can it be priced in at some point? Can the valuations, can the market GDP growth continue, say like in China, but the market not perform?
Well, you must remember, in the case of China, the GDP has gone down. They've had a big downturn in the market and goes in the GDP, and that's been reflected in the stock market as well. But one other important point, and by the way, our previous speaker made a very interesting, shocking comment. He said that the second largest market in the world for them, Bernard Richard, is India. Now think about that. Now here's a company that's not listed in India, I don't think, is it?
French.
It's listed in maybe the US or Europe. So what we're doing now is thinking, let's not just focus on emerging market stock markets. Let's look at the US market. Let's look at the European market, because a lot of these companies are making money in emerging countries.
You know, it's very, Warren Buffett was asked the same question in '87, the year you started. And he said, my exposure to emerging markets is through Coke.
Yeah,
because
exactly.
Coke sells in 100 countries of
Exactly.
the world. Let me bring you back to India since you started on the topic. It's been the third term of Prime Minister Modi's government. The stock market is saluting him. What are the reforms that you think he got right?
What he got right was trying to be all-encompassing to all the people of India through digitization.
The first thing is digitization.
That, I think, was a revolutionary idea and concept that included everybody. He was inclusive, and it accelerated what was happening in the market. I never forget, it was 5 years ago, when they were starting the program with the card, the magnetic card. I went into this little village. There were no roads. You know, the houses, a very poor village. They were doing the ID.
The Aadhaar ID.
They were taking the eye picture, and of course some people didn't have fingerprints. So to me, I thought to myself, this is revolutionary. Because after these people got their card, they went around the corner to a representative of the bank and opened a bank account.
That's Mark Mobius, who's been an eternal bull on India, continuing to believe in the India story and telling Ramesh Damani why he likes it so much. Actually, Niraj, you want to comment on this? You attended this yesterday. What stood out when you spoke to the big veterans yesterday?
Mark Mobius was asked, why is he so fit
Oh,
at
really?
88
Okay, that
years
stood
of
out.
age, amongst other things. So,
He doesn't look 88. I was arguing that with Agam, and he, of course, thinks otherwise.
yeah, and he doesn't, right? Because he's fit as a fiddle.
Yeah.
He walks like without any, forget needing a crutch, but without any hunch or anything like
Takes
that.
a flight at the drop of a hat.
Superbly fit. Most importantly, Samina, he mentioned at the summit that he exercises 30 minutes a day, and he said that this morning I woke up at 7 a.m. and did the bicycle in the gym for 30 minutes. And then he had a lot of other diet-related advices as well.
Yeah.
Recommended people to read the book Grain Brain.
Grain Brain. That's his book. Okay.
But exercising for 30 minutes every day.
Even though I do think there's some element of genes in all of this. But yeah, I guess, okay, that stood out for you.
From a health perspective, he continues to remain bullish, which is a very good thing. And sometime during the day today, a number of times actually, we should also play out what the Bhutan PM had to say about the India-Bhutan ties and why is this India's century. Telling statistic on, or telling thing on how some of the relationships are coming out for India.
I even like the fact that David Cameron took credit and he said, I called out the India story much before everybody else. But anyway, back to today's action. It's going to be a tough day. The trading range continues to move lower. We've breached 24,800 in trade yesterday. Implied Nifty is indicating to flat to slightly higher start, but who knows when that gets sold into in trade. Agam is standing by with more on the FNO space. Agam, 24,700 should be held out today, you think?
Yes, I mean, in general, we're working around with the 500-point range, but on the lower end, we're watching out for 24,500, and on the higher end, 25,000 naturally. But let's take a look at how things have fared. And while we do see marginal weakness on the benchmarks, it was the broader markets which saw sharper cuts yesterday. Sure enough, the Nifty did come off by around 0.3%. It closed below the mark of 24,800, and unwinding coming through in open interest. The Bank Nifty, the picture was very, very much the same, where we did see the index come off by 0.25% and 2% decline in open interest when it comes to its respective futures. We look at the Nifty options market at the moment, and what we've been actually talking about is a 200-point range between 25,000 and 25,200, which could likely be a range as a resistance range for the Nifty. And of course, on the lower end, some crucial technical parameters as well as your put open interest, comes through at around 24,500, 24,600 and thereabout. As I've mentioned, we're working with a roughly 500-point range, and we're bang in the middle of that range right now as far as the Nifty is concerned. Today, of course, is also a day where we likely could see some more pressure when it comes to stocks. We've seen a lot of declines coming in yesterday. In fact, shorts for Dalmia Bharat, Coromandel International, Canfin Homes, JK Cement, Bharat Forge, and even in terms of stocks which saw a decline in open interest, there was a lot of long unwinding in RBL Bank, ABFRL, Manappuram Finance, as well as Tata Communications. Tata Chemicals was one off, which actually moved up by as much as 9% yesterday. The question really comes down to how do we move around when it comes to markets. So let's get in Amit Goel of Amit Ventures, who joins us on the show right now. Amit, good morning and thanks for joining in. How are you approaching the markets right now? What about the benchmarks and what are you doing in them?
Hi, good morning, Agam. Thank you for having me. I'm cautiously bullish. I continue to remain cautiously bullish at lower levels as well. Though we have seen that the market has been trending or moving a little on the lower side and creating lower lows and lower highs on the Nifty daily chart, which is a cause of concern. But as long as 24,500 seems to be defended, I think the near-term bottom the near-term support is at 24,500. So any retest of those levels and a reversal signs there, I could look at building some fresh longs in the Nifty. Though I do have a trade on Bank Nifty as well. If you allow me, I can take you through that.
I was curious because from what I see is that when it comes to Bank Nifty, you're expecting range-bound movement there. Can you take us through the option structure that you're deploying here?
Yeah, sure. So I'm looking at Bank Nifty from a fairly medium-term perspective because I believe perhaps it's a good time for us to stop looking at the weekly trends of or the short-term trends of the indices and look at monthly expiries, because obviously going forward in Bank Nifty we would have only the monthly expiries from November onwards. Apart from that, if I look at the Bank Nifty's structure on the weekly chart, it is at the mean of a regression channel, which it has been maintaining for the last 2.5 years. So I do believe that around these levels we could oscillate between a 1,000-point range up or down. Considering this fact, I am looking to build a short strangle or an iron condor in Bank Nifty for the November expiry, in which we will look to sell the 52,000 put and the 52,500 call. This is actually more like a short-term butterfly, but still, since the strikes are different, we would call it a short-term iron condor, in which we sell the 52,000 put and 52,500 call of the 27th November expiry. And traders who are a little concerned about the unlimited risk nature of a short strangle could look at buying wings by buying the 49,500 put and the 54,500 call, again of the 27th November expiry. I do believe Bank Nifty should oscillate between a 1,000-point range, and with passage of time, we should be making money in this. The target profit here is likely to be about 5,000 with a stop loss, with a rupee stop loss of about 5,000. Given a margin of 50,000 rupees, this works out to a very handsome gain of about 10% ROI.
Right. Amit, The one concern that some traders may have is that they're going to have to be patient with this particular strategy, right? Because earlier on, we don't have as much time decay, and especially now that we're actually midway through October, and you're actually talking about the November end series. Do you think that you could shed some more light in terms of how long we could potentially have to wait for as far as the strategy is concerned? And what point in time do you make an exit? Of course, you already mentioned that if you hit a target of around 5,000 per lot, you go ahead and exit. Are there any variations to this?
A trader would want to wait, would look to wait about 10 to 15 days, 10 to 15 trading sessions, which would be about the first week of November, by when I am expecting the trade to yield results. I would not, since this is a limited risk strategy, I would let the market oscillate. Even if it breaches our break-even points, I'm still comfortable with it, because at the worst end, it is a 1:1 trade with about 15,000 risk and 15,000 reward. But I do feel that the market will oscillate and come inside this range, and be around 52,000, 53,000 by November, which would give us profit in this trade. So I'm not really looking at doing any major adjustments. And as I said, I'm looking at getting comfortable trading the longer expiries, because we do not have weekly expiries going forward in Bank Nifty. That's one of the reasons why I'm kind of trying to educate our traders and investors, our viewers, how to trade the longer expiries.
Well, always more flexibility when you actually go ahead and sell, that particular strategy, or employ this kind of strategy earlier on in, any expiry for that matter. And of course, that flexibility doesn't just come in terms of price movements, but also gives you that much more time to maneuver. And as Amit has mentioned, every once in a while you actually see the strategy test a break-even point. You still have a little bit more time to wait out before you decide to exit. That said, Amit, thank you so much for joining us and taking us through your views on the markets, and of course giving us that option structure to work around with. But don't forget, if you actually do have queries with respect to futures and options space, don't forget to write to us on WhatsApp on the number that is being flashed for you on your screen, and we will be sure to take your queries up on the FNO show at 10:30 today. So don't forget to tune in for that as well. With that, it's back to you all.
Yes, thanks for that, Agam. It is an interactive show at 10:30, so please write in with all your queries, and we'll try and take them up on the show today. But the primary markets are action-packed. We have that much anticipated listing of Hyundai that will hit the markets at 10 a.m. Brokerages believe that while the listing gains may be muted, this is definitely a stock you want to hold in your strategic long-term portfolio, given that Hyundai owns 15% of the market share and also with its big bet on EV. What you also want to remember is that the response from the retail investors, Niraj, was rather muted, but QIBs more than compensated for this with a 7 times oversubscription. So I think Hyundai is going to be important, a flat start, but I think brokerages do believe that even if you get that opportunity on listing morning, which is today, it does still look like a good buy. So maybe a flat start and some build up through the day. Who's to tell?
Yeah, but it's interesting that, Samina, what are they talking about? The portfolio, upcoming portfolio, as a result of which this might happen, or what is the key reason?
I think the upcoming portfolio is what they're betting big on. Margins are better than its peers. The only thing that may not work against it is the valuation, and I think that's been the biggest worry for Hyundai. And it gets even worse today because post the subscription, one of its closest peers that was valued at in comparison was Maruti. M&M, of course, trades at a bigger premium because of the growth prospects for that one. But let's not forget that in the last 5 to 7 trading days, Maruti has also corrected significantly, which also means that Maruti now is available at a discount as compared to Hyundai. So a listed player versus an unlisted until 10 a.m. this morning, it does become something one needs to watch out for. So if you still have to go out and buy, Maruti is actually relatively cheaper now as compared to Hyundai, and that's going to be a tough rope to walk. But that apart,
and throw in a Mahindra there with its portfolio of SUVs.
Yeah. And the fact that they've corrected too in the last few days, so they've gotten cheaper as compared to what they were 1 week ago when we talked about this.
Yeah, and because M&M also brings in a suite of the other companies out there, and the tractors have a very positive calendar year 25 to themselves. So could be interesting.
Yeah. Also, I very quickly want to mention two other IPOs that opened yesterday, and Vari Energies is a standout for me. The reason I bring this up is because, remember, they opened a price band which was at 100% discount to its unlisted price. And that meant really good news, because if you look at the way it's been oversubscribed in the first day, is impressive to say the least. 3.5 times on day one. The grey market premium already is 110%, which means the listing gains could be upward of 100%. It's a fairly large IPO as well, so it's to the tune of 4,000 odd crores. So if you're a retail investor looking to subscribe, there is a good chance you may get a sizable allocation of this one. Of course, Vari Energies listed peer is Premier Energies, which is already trading at a premium. So, and most analysts believe that if you compare Vari, which is a big player in the solar space, versus Premium Energies, Vari is far more attractive in terms of valuation, order book, and the fact that they've grown significantly well. So if you're lucky, Vari Energies could be one that you may get an allocation to. But we'll talk about all that and more at 9:45 with our guest who specializes in the primary markets. Coming back to the action in the secondary markets, a barrage of earnings have been reported. Anushi is standing by with more on that. Anushi, Niraj and me have already highlighted a few big ones, but what else do we have?
Hey Samina, so quite a list that is to be focused on for trade today. First one is City Union Bank. Now they've reported a 1.42% of a growth in their net profit at 285 crore. This is against the expectations of 272 crore. Net interest income, if you look at 8% of a growth at 582 crores. The NPA numbers, which is the gross NPA numbers, that saw a sequential decline this quarter to 3.54% versus 3.88% last quarter. And net NPA also similar thing, 1.62% as compared to 1.87%. Moving on to the logistics space now, Mahindra Logistics, if you look at the numbers, revenue saw about 11% growth, and this was majorly in line with what the street was pegging at. EBITDA 22% growth, and the margins were up at about 4.33% as compared to 3.95%, but slightly below the estimates of 5%. Net loss also, if you look at YOY basis, that has reduced from 16 crore to 11 crore of a loss this time. Some of the key highlights: this growth was driven by the 3PL contract logistics, cross-border and last mile delivery, but soft demand environment and operating conditions continue to impact the express business. Even the ongoing geopolitical conflicts continue to impact the cross-border market. Now focus remains on H2, wherein they're making higher investments in the eastern and northeastern regions, and they expect to ramp up their capacity there. So focus remains on H2's performance. Coming to Balu Forge here, the very strong set of numbers that we are looking at: 60% revenue growth at 223 crore, EBITDA about 116% growth, EBITDA margins 29.5% as compared to 22%, and net profit has almost doubled to 48 crore as compared to 23 crore. Do note that in the last 6 months, the stock has more than doubled in the period. But on to some of the key highlights: it specialized in engineering products, and client addition has led to the strong revenue growth that we are looking at, and increased demand for higher products has yielded in this better margin. So these are some of the stocks that you need to focus and trade for today.
Okay, yeah, most certainly watch out for these for sure. Okay, let's try and talk about what to do in the trade today on the back of this. Maybe we'll speak to a few companies as well, but technicals first. Rajat Bose, SEBI registered research analyst, and on the fundamentals, Sunny Agrawal of SBI Cap Securities. Gentlemen, both of you, thanks for joining in. Rajat, how are you approaching the index today? More importantly, can it be that the Nifty remains flat, but the correction ensues or continues at the mid space?
The situation now is, I would say, is somewhat quite critical, in the sense that chances are that you will see this correction that is happening at the moment may continue further, because what I see is this, that there had been several attempts in the Nifty to cross the 9-day exponential moving average. There was a time since June 4th till about middle of September, this 9-day exponential moving average used to support this index, and now it is creating problems. So it needs to take out 24,800 decisively. Only when it manages to do so, then you will see some kind of a recovery. If that happens, then the next target that you would look for is 24,870. Once 24,870 is decisively crossed, then 25,000 or 25,100 would be your target. On the downside, unless, of course, there is a fall below 24,600, there would not be much of a problem. And if it were to fall below that, then what we have to see whether it breaks 24,567, that is a recent low. If that gets taken out, then there will be the major support of 24,000. So I wouldn't say that it is going to go up, or I wouldn't say that it is going to go down. There is no directional move at the moment. Directional move would happen only above, say, 25,100 or below 24,000. So now it is a range-bound scenario where you play buy weakness, sell strength. Regarding Bank Nifty, that's a bit better situation. I would say unless it breaks down below the 50,000 mark, that is actually 2,000 points from the current level, there is not much threat as such, but it needs to take out, say, 52,700, 52,600 decisively. Only then you will see Bank Nifty getting some traction. Otherwise, there is a possibility that 51, say 400 to about 51,100 might be retested.
Thank you for that, Rajat. We'll come right back to you. We have the management of Cyient DLM. They've posted earnings that I think largely have been very impressive, beaten street expectations in terms of revenue growth. Profits have remained more or less flat with a slight uptick. And of course, they've also managed to bag two very big orders, one from a defense company in India and the other being a global oil field servicing company. So we'll get some more perspective on that and a picture of the order book too. Srinivas Kulkarni, CF of Cyient DLM, joins in. Srinivas, good morning. Thanks for joining in. First up, congratulations. It seems like it's been a good quarter, a good beat in terms of revenues, up 34% in this quarter. Profits are up about 5% You want to tell us what drove growth this quarter?
Thank you for having me on your show. Yeah, it's been a good quarter in terms of the execution of the order book that we had. I think we had a very large execution coming up for the India work that we do, which has resulted in a 33% growth year on year for us. EBITDA is marginally positive for the quarter. However, our finance costs have gone up a little bit during the quarter due to elevated borrowings, and that is, that means that the PAT growth was only about 5.5%. But all in all, I think it's been a good quarter, especially with the acquisition that we announced earlier, and the way we look at the business in terms of how it is shaping up. We are quite pleased with the results and look forward to the rest of the year.
Understand this, and I know you said that you've picked up some very significant clients in India, and that could have led to a big jump up in your top line. But profits haven't moved in line with revenue. Is that because the business is coming from India and you've picked up low profitability or low margin business in order to acquire the clients? You want to help me understand that?
Yeah, the operating profits have moved in line with the revenue. It is the net profit which is not moved in line. The reason for that is the higher finance costs. Our borrowings have been at an elevated level in Q2. I think there is a lot of money that you need to deploy in the working capital, and our cash flow has not been positive in the first half of this year. We expect that to turn around in the second half of the year, which basically means the financing costs have gone up, and therefore net profits are not in line with the revenue and the EBITDA growth.
What has led to such an elevated requirement of working capital, and if you expect that finance cost, what does your finance cost stand at this quarter? And if it's transient, you want to tell me what is going to lead to that turning the corner for you in the second half of the year? How will your working capital requirements ease off? Will you start getting payments? Is it how are we playing? How are you charting that out? Because you are the CFO, and I guess you've got a better understanding than anybody else.
No, absolutely. So there are two main aspects of the working capital blockage. One is the inventory. I think we have a significant buildup of inventory. That is actually, the built up because of the expected orders that need to be executed in the rest of the year and even in FY26, right? But as we start consuming the inventory, and some of these have longer lead times, so we procure ahead of time, right? And therefore working capital gets blocked. So for a temporary period, the borrowings look very high, and the working capital looks, the net working capital days look high. But we've already improved in Q2 compared to Q1. But it's still at an elevated level. I think we are working on a number of different initiatives to bring that back in control. Once that happens, I think it's only a question of time that the finance cost goes down. Our borrowings actually have come down if you take the end of the quarter number, but on an average for the quarter we had deployed higher working capital. And same with the receivables, that's another aspect where the money gets blocked. We had some large orders that were executed at the end of the quarter, so those gets collected in this quarter. So second half of the year, both will happen. Cash flow will turn positive as well as the financing cost will go down, and therefore we will see better net profit conversion compared to the revenue growth and EBITDA growth.
So you've signed two very big clients in India, right? One being an Indian defense PSU and the other being a global oilfield service company. On back of which I guess your India book is looking so very healthy. You want to draw out the payout plan or the deal that you managed to strike with them? Is it a one-off? Is it a long-term deal? The payments will be milestone-based. Just give us a better understanding. Is it a recurring deal, more importantly? Because we want to understand whether is the impact just going to be on this quarter, or will we see it over a sustained basis over the next few years? And the potential to increase market share, wallet share on these clients.
Yeah, both clients are very strategic for us, and in this business, you don't start with the big bang order. You always, it will phase in over time. Right? I think you start with a small order, you execute that well, and then grow the account. What we see when we add new logos is the potential for those clients to become large clients. Right? We don't want to go after these one-off deals. That really doesn't help us. So I think both these clients, while they're significant in terms of addition, there is no immediate impact on the current quarter's numbers. I think it will slowly build up over the next couple of years, right? And they both have potential to become large customers for us.
Am I right that your order book is still declined about 13% despite these two big wins?
That is right. And like what the order book that we show is only for the firm purchase orders we get. There is a little bit of lumpiness in the order book, right? I think what happens is Sorry, was there a question?
Yes.
Yeah. Srinivas, just one question from my end. You are adding revenues from the acquisition Q3 onwards. You're talking about how the net profit margins which were off will also recover. Now, I'd like to understand, are you giving a formal guidance, or have you given a formal guidance for FY25? If not now, then earlier. And is there a challenge to meet that on the bottom line, not on the revenue front, but on the bottom line front?
No, we have not given a formal guidance.
Okay,
right?
You haven't. In which case, my question is, does the uptick in net profits look commensurate with the uptick in revenues in Q3 and Q4, depending on whatever the number is?
Yeah, it does. Yeah,
it would.
It does. Yeah.
And the acquisition, Alchem, I believe that's the name, adds to the top line growth for Q3 and Q4 as well.
That is right. For the full quarter, we will see the impact because we did close the acquisition on 4th of October, so we will have benefit of the full quarter coming in. So yeah, we will see the addition of those two as well in Q3 and Q4.
Right. Just very quickly, Srinivas, there's been a big demand drop from one of your big customers, about 50% YOY. With this new acquisition contributing to your top line in the next few quarters, will that offset the loss of revenue from that big client of yours?
Yeah, it does definitely offset. I think, of course, we are still working through that client to get the order book back in shape. There is a little bit of a delay there, but yeah, it does offset that.
Okay, thanks Srinivas for joining in today and giving us that perspective. We'll have to slip into a very quick break, back with the pre-open session. Back with India Market Open right here on NDTV Profit. Remember, we'll have a flattish start in the session today. The question only is what to do with specific pockets in a scenario like this. Sunny Agarwal has been waiting by patiently with us as well while we were talking to Cyient DLM. Sunny, thanks for joining in. Actually, just before we get to the larger specifics, did you guys track Cyient DLM numbers? What did you make of them? Maybe you heard the management as well.
I think again, Niraj, first of all, good morning to everyone and thanks for having me on the show. I think Cyient DLM again, revenue was in line, but due to increase in operating expenses, especially on employee side, we have seen some pressure on the margin. But again, on a EMS, if I take a broader perspective, EMS as a story will continue to do well over the next 3 to 5 years. And looking at a niche offering from a Cyient, I think we believe that next quarter or two, or maybe next 2-3 years will be pretty good for Cyient DLM. Overall mixed set of number, revenue in line, muted profitability due to pressure on margin. So again, at the current juncture, looking at a valuation, I would like to remain neutral on Cyient DLM. We'll like to wait for how this new acquisition will add to the top line and operating margins in quarter 3 and quarter 4. So as of now, I would like to remain neutral, and there are many other better play which are available in EMS, companies which are proxy play on air conditioning market. So companies like EPACK, Amber. At a current juncture, I would like to bet my money on those companies.
What did you make of the EPACK Durables announcement? They've signed a large deal with Hisense. It's a global Make in India deal. Is that a re-rating candidate?
Yeah, kind of. So, I mean, growing at north of 30%, and at the same time, the way the commentary from the whether it is an OEM player on air conditioning market or EMS player, whether it is EPACK or Amber, I think even quarter 2, the demand was pretty robust. And quarter 3, we will see again built up of inventory for summer season. So I think we believe the fair value of EPACK is close to 500 rupees over the period of next 6 to 12 months.
Right. Rajat, what about you? What are your top trade recommendations this morning? While the benchmark is going to be range bound, I'm sure there'll be lots of stocks, both on the long and short side this morning.
Yeah, I would be talking about long side stocks because I can't give futures recommendations. So I would restrict myself to giving long thoughts. ITC looks good to me in the sense that it has already almost from the lows of lows posted around, say, June 21. It was around, say, 420. And after that, it has moved up to something like 528. 38% retracement has already happened. What I see is that 2 hammer lines that suggest that when it goes down, close to about, say, 475 or so, there is quite a bit of buying. Even we saw this buying 2 years back around these levels. So now that is supporting it. So chances are you will see a movement on the upside. So stop loss just below 475, that is 474, and 493 and 498 are the 2 targets for ITC. The other stock that I would like to recommend is GRAC, that is Garden Rich Shipbuilders. This stock has actually corrected quite a bit, and then there has been a range-bound movement, and this range-bound movement still continues. For the first time, it has given a movement above 50-day moving average, although it closed again coming down because of yesterday, lots of stocks were going down. So I would say that it closed at 1801 and 1769 should be the stop loss, and on the upside 1834, 1851 and 1869. These are the 2 targets for Garden Rich Ship builders and engineers. One last comment that I would like to make here is that Nifty is hiding much more about the market than it reveals, because trying to look at number of stocks, more than 250 stocks I went through yesterday. Most of them are showing weakness. Even this Nifty Junior has fallen nearly 1.5%. But somehow Nifty is being propped up to show that we are still in a hunky-dory situation.
Right. Well, that's the call coming in on a couple of picks from Rajat this morning. Rajat, one quick one that I want to have a quick follow-up on. Actually, it's 9:04, so we'll do our brokerage link and then, of course, come back to you. The markets in pre-open trade are flat. The Sensex is trading with a 30-point cut, while the Nifty has reclaimed 24,800, just a tad bit. There'll be lots of counters that will be reacting to earnings. If you can just quickly see Bajaj Housing Finance and see what it's getting up to, just before the markets react to its earnings in just a few minutes, 2.5% higher, so not too bad. Stocks like Tata Consumers may see a little bit of consolidation after that big fall in trade yesterday. Tata Consumers expected to see a flat start as well. It'd be interesting to see if HDFC Bank continues its up move in today's day of trade, and then of course all those counters from the broader markets that had been on the sell side yesterday will be in focus this morning. Cement is another pack you want to track. Ultratech missed street expectations. Net profits declined over 35%. But the management commentary is what we'd like to understand more about and what brokerages thought of that. Mika, very quickly over to you. What did the brokerages make of the analyst meet? And what were the key standouts from the management this quarter?
Yeah, bad set of results from Ultratech this quarter, but that was expected. EBITDA per million ton actually fell to 732 rupees, which is a multi-year low. Now, when you talk about the Q2 con call highlights, well, management stated that even though the company saw 3% volume growth, was higher than the negative 0.5% to 1% industry average. They expect volumes to grow in double digits starting from H2 of FY25, and they expect better demand as well as better pricing in the second half of the year. They expect 250 to 300 rupees per ton savings in operating costs over the next 3 years, and they're confident to hitting their 184 million ton per annum capacity target by FY27 end, and this excludes the Kesoram Industries and India Cements acquired assets. Now, FY25 capex will be 8,000 to 9,000 crores, and there'll be 9,000 crore capex annually for FY26 and 27. We talk about how brokerages have reacted. Well, Jefferies has maintained its buy rating but cut the target price to 12,500, but this still offers a 15% upside. Nomura's same maintained buy rating as well as its 12,350 rupee target, which is 13.6%. Nuvama is the most bearish in terms of its rating as well as target, a hold rating, and it's cut its target price to 11,238, which offers only a 3.7% upside. When you talk about what the key brokerage views are, well, Jefferies expects that the multi-year EBITDA per ton metric has likely bottomed down and the company is better placed versus peers compared to its in terms of its cost-saving efforts. They expect EBITDA per ton of 1,000 in FY25 and in the range of 1,120 to 1,220 in FY26-27. Nomura has trimmed its FY25 cement EBITDA per ton estimates by 10%, but they maintained the FY26 estimates at 1,400 per ton, and they expect better Q3 EBITDA per ton, which will expand by around 335 rupees. And lastly, Nuvama, the bearish of them all, has revised its FY25, 26 as well as 25 EBITDA estimates by 9%, 5% and 3% respectively.
Okay. Thanks, Mihika, for the same. Is cement a avoid Sunny Agrawal, or would you go out and maybe now buy? Because there are a couple of brokerage houses which are saying that it's time to get constructive on cement.
Yeah, so cement, Niraj, you have always seen that second half is especially post festive season where there is a availability of labor also. So second half is anytime better for cement, any cement company. And looking at the Ultratech commentary, I think the high fuel cost or high fuel contract is likely to get over, and the benefit of lower fuel will start kicking in for the Ultratech, and I believe the same will be the trend for other players also. And at the same time, if industry is going to grow at 7 to 8%, a player like Ultratech, which is following strategy of organic as well as inorganic growth, so I believe they will beat the industry growth at least by 100 to 200 basis points. So again, cement proxy play on infra and real estate, I would like to keep it in my portfolio. But rather than focusing only on large cap companies, a few smaller players like JK Lakshmi, where we have seen a recent capacity commissioning. At the same time, Star Cement, which is a proxy play on predominantly a player in northeastern region. So these are the few smaller players which we like and would like to ride for medium to long term.
Okay. Well, some cement names. By the way, the thing that is looking really interesting is MCX. Now, HDFC Securities up the target price to 7,100. UBS has gone further and raised the target price from 5,000 to 8,000 rupees. That's the new UBS target, because they say there is likely to be exponential growth and new launches like monthly gold options, which are catalysts in the next 12 months. In the next 12 months, their earnings estimates have risen by 60% and 75% for FY25 and 26 respectively. They say that their Q2 performance was strong and Q3 is looking better because volumes and premium increase are driving the better revenue growth. I mean, it seems that while everybody's focused on capital market players, this one falls in that bucket, but commodity trading volume has gone through the roof, as Q1 and Q2 have shown.
Yeah, so these platforms have seen significant gain, right?
But MCX in particular, Samina, seems to be, I mean, the numbers at Q2 and then the expectations, as the UBS note also says, for Q3. They're saying Q2 was strong, Q3 is looking even better.
Even stronger. I don't know how much of that is in the price, Niraj. The stock is up over 400% in the last 16, 17 months. So if you had bought the stock even early last year, the gains would have been phenomenal. So while the growth is there, I don't know whether the stock, how much upside does the counter have? And also when the counter reported earnings last week, the stock didn't react positively to it, right? So despite a very strong Q2, the performance on the counter was muted. But Rajat, you want to come in on this, and I'll get Sunny's view too on it. What do you think? On the charts, how does MCX look? They seem very, very optimistic about the next few quarters, but the stock is also at 400%.
You are right. It has moved up by 400%, and in last 1 year or a little more than that, maybe 5 quarters, it has moved up by 5 times from 1,300 to 6,500 or 6,600 kind of levels. So now, if it were to move further up, next target will be 6,800 to 7,000. I would say I wouldn't recommend a buy at current levels, because if I see the weekly chart, that is very scary. But anybody holding this stock should put a stop loss below 5,900 on closing price and carry on with the momentum. Because
Rajat, I'll have to cut you in because there is a news flash. Breaking news out there. Ambuja Cement is in pact to acquire a 46% stake in Orient Cement at an equity value of 8,100 crores. Now, this means this brings in the pricing of Orient. Let's put up Orient Cement, please, if we can. And the pricing, I think, is 395, if I'm not wrong. The current price for Orient Cement is 353. I expect this stock to have a bump up right on open in about 2 or 3 minutes. But this is a very interesting announcement and just goes with this whole consolidation of cement capacity. Ultratech buying out India Cement. Ambuja has done one large acquisition in the past. Now they've bought in serious capacity by buying in Orient Cement, Samina. This is big news.
Yeah, and I think somewhere around last year, wasn't there talk about this happening? There was some, parts of the market that believed that CK Birla had actually approached Gautam Adani for the cement business stake sale. Now, of course, that news is confirmed. They've gone on and made that acquisition and acquired a significant promoter stake in Orient Cement. Remember, Orient Cement is part of the Birla multinational conglomerate. And of course, historically, there have been demands or efforts to acquire this company by other players, but those were failed. This time around, a success coming in from Ambuja Cement of this acquisition. A quick check of how the stock has been doing in the last couple of months will give you a sense of whether how much of that was in anticipation of an acquisition. This morning, trading flat, but I think as the day goes along, Niraj, this is good news coming in for investors of Orient Cement. The stock should pick up gains as we go along through the day.
Yeah, Sunny, very quick thoughts here on what this deal means for both the companies.
I think yes, Orient Cement deal was in the market earlier, and the deal was expected. I think Ultratech was also in the fray. I think positive for both the players. I think the acquisition is at a higher price compared to the current market price. So I think a positive for definitely shareholders of Orient. And for Ambuja, which prior to the acquisition of Adani Group, the group was struggling with a limited capacity. And I think with the inorganic growth strategy, as we were discussing earlier, which Ultratech is also following, I think ultimately consolidation is the way forward for the cement industry, and that again strengthen our belief that the cement pricing is something which will continue. So ultimately, cement maker will have a price making decision, and again positive for Ambuja also because they get an access to southern market by acquisition of Orient, southern as well as central India.
Got it. Okay, just about to start off. Remember, 46% in Toto. So the open offer announcement should come in at some point of time, as Samina was saying. But 5 seconds left. Let's focus on the markets, but we stick with this news because this is a big thing, and the cement consolidation is alive and kicking and here. But this is how the markets are starting off. Flat as flat can be. Let's pull up. Maybe this one, which is Orient Cement. Because that's the big recent news maker, and just see what that one is doing before we get to the heat map. Ambuja should also be interesting. Orient is up 6-7%. So Samina was right. This one is reacting positively. Ambuja Cement 1.75% higher. The valuation is interesting. We'll get to the valuation check in just a bit. Bring up the heat map and show you what's moving and what's not before I hand it over to Samina for what's happening at the broader end of the spectrum. Not too much happening. I think Samina will have to come in sooner because on the gainers list, it's Maruti, Tech Mahindra, Wipro, so some bit of IT. But on the losing side, life insurance companies certainly correcting in the session today. So therein lies the problem. So not too much to write home from Samina on the large cap end. What about the broader end of the spectrum?
We've got Rakesh Arora, fortunately, so we'll quickly go across to him. But a quick mention, Orient Cement has already been talked about. Niraj highlighted how the counter has reacted well. 6% higher, no surprises there. This will, of course, trigger an open offer. It's been in the market for quite some time now, the news, and hence the reaction being positive. You will have the counters such as a Cyient DLM responding to earnings, MCX, the brokerage note, Bajaj Housing Finance to its earnings, as some of the other counters you will be tracking closely in today's trade. Rakesh Arora of Go Advisors joins in. Rakesh, good morning. This has been in the market, the news, of course, for quite some time now, but confirm now, Ambuja Cement is acquiring a significant stake in Orient Cement. What does this mean for Ambuja? What does it mean for shareholders of Orient Cement? And will this trigger an open offer?
Okay, so it's an excellent deal for Ambuja Cement because market was widely expecting Ultratech to take this asset. So Ambuja is a little bit of surprise package here. Orient is a very good asset. They have, decent plants and a lot of limestone availability. So overall around 16 million ton they can reach based on the current capacity and the plants that they have. Valuation, this was kind of expected between 375 to 400 rupees. So it come at around 395. So I would say in the range of valuation where people are expecting. Obviously there will be an open offer for 26%. So Adani or Ambuja is buying around 46% directly, plus they'll have to buy 26% from the open market. So acceptance ratio would be around 50% or so. As the open offer price is, 395. You can expect that the stock should stabilize somewhere between 370, 380.
Okay, interesting. Rakesh, yeah, so 361 currently. So people who are quick traders as well, watch out for that. Rakesh, what does this mean for Ambuja now? And the two large players solidifying their capacity addition plan. So what does it mean for Ambuja? One, because I heard you say it's a surprise package but a positive deal. But two, more importantly, for the other large cement companies as well, Shri, Dalmia Bharat, for example.
So, meaning Ultratech and Ambuja are taking a strong lead over the third and fourth player, and they will continue to grow much faster than the remaining tail that we have seen. Currently, I would say Ambuja is doing better acquisitions. Sanghi was a great acquisition they did, and even Penna Cement that they did was a really good acquisition. So I am finding their acquisition strategy to be slightly better, and they are adding good assets. So I think Ambuja could be one of the stocks for investors to consider from a longer term perspective. They will grow much faster than industry. They have shown cost control. So Ambuja is doing all the right stuff.
tender in. Rakesh, so I'm assuming this is a very clear thumbs up for Ambuja Cement. Do you have a target price on the counter? It's of course doing a little bit of a runaway as we speak at 581, 582. Where from here in the near term, like you said, 3 big and very solid strategic acquisitions. They gained control of the South market, which is what they were seeking, and I guess it's a perfect fit.
So, Mary, I won't really put any price targets. I don't cover the stock. But long term, obviously Ambuja is doing all the right stuff, so the stock should continue to do well. Having said that, one should remember that earnings are weak. We had a disaster of results coming out from Ultratech yesterday, and Ambuja would also have to face that weak earnings. So from a longer term perspective, only I think investors should look to accumulate.
Just before we talk to you about Ultratech, because we're, I think, fortunate to have you on the phone this morning. But just before that, what is the advice to Orient Cement investors? Would you advise them to tender in to the open offer?
I think it is better to tender in at the open offer because having looked at, the previous acquisitions of Tenna and Sanghi, they were in no real hurry to merge. And they did, agreements to do kind of tolling at Sanghi and even now at Penna. So I'm not 100% sure that, Orient shareholders should stick around beyond the open offer. They are better off switching to Ambuja once the open offer is done.
Interesting is Orient Cement opened 7% higher. The stock is already eased off and given up all its day's gains at the day's low point, 357 on Orient Cement. Also because we are lucky to have you on the phone, what's the word on Ultratech? The numbers were a huge disappointment. Where from here? I mean, such a big cut in terms of all parameters of the quarter. Where and what is the view? Do you think next quarter onwards there could be a little bit of a turnaround, or it still looks far-fetched?
So cement prices have moved up a little bit, post the Q2, and we are also seeing a little bit of pickup in demand. So there is recovery going to be there in second half, which normally happens seasonally. But Q2 we had a lot of extended rains and demand growth was only 2-3% for Ultratech. So the fixed cost actually jumps up quite a bit, and it's difficult to model in. So that's why there is disappointment in earnings. But I think long-term investors will overlook these, small weaknesses, for a quarter-on-quarter basis. I think longer-term story remains intact.
Rakesh, great talking to you. That's the view. Cement prices are moving up. While it's been a tough quarter, markets are not being as harsh to cement counters this morning as we've seen them be to other stocks over the last few days. As expected, Ultratech is getting a gap up, 1.5% higher is what we have. Orient Cement is off the day's high point. Ambuja is also getting some sort of a gain kicking in. Investors should be excited because Ambuja has been on an acquisition spree, and the acquisitions they are making seem to be better than its competitor Ultratech, and more importantly they seem to be fitting just like a glove with strategic acquisitions in geographies such as the South, which was with Orient Cement. So all in all, thumbs up, Niraj. I think cement is looking good this morning, and this acquisition news may be a positive for the whole sector in some way.
Yeah, I mean, but interesting dichotomy between, or views between what some of the individual cement counters are doing as well. But let's quickly figure out from our experts, and while we mark other stocks, as to what their opening views are. Rajat, quick opening thoughts on anything that has stood out for you in the first 8 minutes of trade.
I would say that if you have to buy any cement stock at the current moment, it would be Ambuja Cement, because that has corrected quite a bit. Ultratech also you may look at, but from a trading point of view, I don't think Orient is going to give you anything great. Other than that, I would say that, say a hospital stock like Apollo is doing fine. So Apollo, unless it falls below, say 69.70, it is likely to move up. Caveat has it that I personally hold some shares of Apollo in my investment portfolio. Tech stocks are, I really don't find that much of things, any good thing is happening out there. One stock that looks good is Reliance. It is, once it crosses 27.50, there could be some move there. So you can get into that. Say Reliance 2760 will be a resistance, and after that 2772. TCS is one tech stock. There will be some movement that can happen. 4105 to about 4110 could be possible in today's sessions. And overall, as I said, that it would be more of a range-bound scenario. Initially, maybe you will see some traction on the upside, but later on, as we have seen a number of times, there could be some selling as well.
The market's as flat can get. We are pretty much just holding on by a close, I think, at 24,800. Still not looking sustainable. The broader markets are seeing weakness, and I think that's what remains a concern for the street. Bank Nifty as well, which we were hoping will lend itself to the Nifty, is failing as well this morning. So underperformance on Bank Nifty is what we have. Lots and lots of losers. Metals as a pack is looking weak. A quick check on how some of those earnings reaction are. We highlighted a few earnings for you this morning. Balu, Forge, was it? If I can pull that one up, the numbers were phenomenal. It's a relatively small company, but even despite such a good showing, the stock sees only a 0.5% gain. Take a look at Cyient. They reported numbers that were not too bad. Autumn Investments reported numbers that were not too great. Cyient is down 4%. Like I said, the revenues were good, but every other parameter of the reporting hasn't stood out. Their order book as well has been shrinking. Their finance cost has seen a big jump. All that put together means bad news for the company. Autumn Investments, huge disappointment of earnings. The stock, for good reason, is down 8%. City Union Bank has impressed the street in every way. The counter sees a 10% up move. 361 WAM has also reported numbers that, in my opinion, were a beat. The counter, despite that, is seeing a cut of 2.5%. So 33% growth, but I don't know what the market expects out of them. But they've managed to do well. The stock still, though, a lower downtake. Lemon Tree has made an acquisition. Markets ignore it. The counter continues to sell off and sees a cut of nearly 1%. Bajaj Housing Finance earnings reportage was good. Management has said that the competition is stiff going ahead, but they do believe the kind of guidance they've given is largely doable. The counter seeing a flat sort of start in early trade. Niraj, anything else from the broader market that stands out? I'm just surprised with what the market is doing to even half decent earnings.
Yeah, but City Union Bank, a case in point, just quickly pull up the Macquarie note and we put out what Macquarie had to say when it comes to City Union Bank. I think the view was unequivocal, if you will, and they are saying that this is a corner. They are turning a corner, if you will, or something like that, and that I've given the graphics for my trade setup. That they have, it's the first of the many good of the good quarters. They have an outperform rating. A target price is 185. Growth engine finally turns on is the point that they were trying to make. So watch out, and they're saying that the risk reward looks favorable. So watch out for that. PNC Infra is the other one. Just very quickly mark that, because MOT, which is the Ministry of Road and Transport Highways, has disqualified the company from participating in any tender process yesterday. The stock was down 20%, down about 6% in the session today as well. So watch out for these. Okay, Sunny, before we let you go, anything in the mid-cap space? I heard you mention the EMS plays. Is that the top draw, or is there something else? I mean, would you buy an EPACK Durables at 5% higher today, or are there better stocks to invest in?
Yes, definitely, Niraj. EPACK is a good buy at a current level, but I would like to add one more pick based on the recent result release. So, Newgen Software Technology has reported a very strong set of numbers. So basically, a IT product company which caters to predominantly banking and financial services industry. Draws revenue both from annuity as well as service pack, and I feel the kind of patent and product which the company is sitting on, I feel the fair value of the business is close to 1,500 rupees with investment horizon of 6 to 12 months.
Seem to have got a thumbs up on the Ambuja Orient acquisition. The stock is now turned flat on both Orient and also on the way Ambuja is doing. Another one I want to pull up is Jana Small Finance Bank. If you can pull that one up. They reported earnings yesterday. Numbers were nothing great to write home about. Let's see what the markets are doing. They are hammering it down, 7% lower on the counter is what we have. So it looks rough. It looks rough for a lot of the stocks out there this morning. MCX as a brokerage upgrade. The commentary is exceptionally positive about the outlook going ahead, and the counter trades flat. The good news is that Bank Nifty, which started the day off soft, has now turned positive with a little bit of a gain of about 0.2%. So as I was hoping, maybe there will be a little bit of support that Bank Nifty will lend to itself. But the only sectoral green that we are seeing this morning, Niraj, remains to be cement. Rajat, any of those cement names? I mean, we talked about Ambuja and Orient, but anything else in the cement pack that looks like a good long trade? And would you buy any banking name intraday on betting on a bounce back on Bank Nifty, because it is now gone back into positive territory?
Ultratech can be bought. Ultratech in the cement space, at least you can see a movement towards 11,500. 11,450 to about 11,500 would be a resistance zone. Only if it manages to get past that, then further upswing can be expected. And regarding banking stocks, I would say, again, City Union is the best play, because it is a very strange phenomenon. Yesterday, there was a bearish engulfing pattern that was a big one. And then today, it's a sharp jump up. So if it sustains here, put a stop loss below the today's low, that is the 50-day moving average. And your target would be somewhere between, say, 173 to about 175 on the upside. But don't forget to book profits around those levels, whatever colorful commentary that there is.
Yep. Certainly an interesting one. Okay. Thanks so much, both of you. Some news flashes on your screen, just want to mark that. But okay, this is Autumn investment to acquire certain real estate businesses of NITCO assets from promoters for 300 crores in agreement to issuance of fresh warrants by NITCO for up to 225. But Autumn, of course, down 8% on the results. Keep that in mind. Small acquisition, really, nothing too large. Okay. Jana Small Finance Bank, shifting focus to that one. The Q2 net profit slumped 21%, while NI saw a jump of 13%. We're joined by Ajay Kanwal, MD and CEO of Jana Small Finance Bank. Welcome to the show, Mr. Kanwal. Let's start off by the challenges in the asset quality. Talk to us about what's happening there.
So let me tell you briefly about the bank. Started 6.5 years back from a microfinance institution, which was our origin. We were an MFI since 2008. And one of the primary strategies we adopted was to convert to a secured bank. By secured, I mean assets like mortgages, LAP, gold loans, etc. And over the last 6.5 years, 65% of our asset book is now secured assets. So that's a very important thing to remember. Now, the balance 35% is microfinance, which is as of September. And clearly, as you may have heard in the industry, there is stress in the microfinance sector. Even though it's a small book for us now, we are not outside the industry, so we have seen some of that impact come to us. That has caused an elevated credit cost. And I must say, most of it was unanticipated. We could not see this coming in such a strong manner across the industry. And so obviously that has caused a rise in gross NPA. Given prudence and being conservative, we have provided, which is why net NPA is at 0.98 and PCR is at 67.5 or 67.6%. So we are well provided, we are well provisioned. And I must tell you that the way we see it, the peak of the credit cost is already passed in Q2. It will get better in Q3 and further better in Q4.
So then let's try and understand this better. Is it a fair assumption or understanding for us that for now you do believe that the bottom is behind the bank and the second half of the financial year will only get better?
It is my belief that this stress in the MFI industry is man-made and not externally induced. So in the past, if you see, stress used to come from things like COVID, right, where we have no control, or it will come through some social event. There is no such reason in the last 6 months to say that is because of that. So the only thing I can think of is it is a case of over leverage of customers through variety of institutions. And I can see that if you look at all of the industry, we will see, of course, muted growth, which means people have become very careful. People have realized there's this path of growth where one doesn't follow disciplines the way they need to be followed, can lead to a problem for all. I think is obvious to everyone, which is why I feel Q3 will be better. I mean, you take our simplest example, our growth for unsecured book in the first half is negative 7%. So obviously, if I have degrown the book, I will have less problems anyway. Forget that the worst is already flown, because in unsecured, people, if you are defaulting, you kind of default and you actually go to NPA pretty quickly. It doesn't take long. In secured, the chance of you holding in bucket 1, 2, 3 or SMA 0, 1, 2 is higher. In unsecured, it becomes, if you're a over leverage customer, you can't pay, it goes on very fast. So I think the worst has flowed in. I think the bigger question that all of us should ask is, how will the industry dynamics shape profitability, ROAs look in the future? Because growing too fast is not correct. Giving too much leverage is not correct. So which means all of us have to work backwards and rework our models, at least if you're a large unsecured player. For us, long time back, we took the bitter pill and said, listen, the best way to build a good, resilient bank is to go towards secured assets. So we built it over the last 6.5 years.
Okay, so what does this do to loan growth for you?
Let's look at the basics, which means long term is intact. So asset of 20%, yes, it will happen. Growth of secured remaining at 67, 68%, that will happen. Growth of deposit business at 20%, that will happen. So three things will certainly happen, which means there is enough and more tailwind for the bank. Now what will happen is, yes, elevated credit costs will mean lower profitability for this year. How much lower? I think we'll have a good estimate in the third quarter. So yes, remaining at, we had given a PAT guidance of 30 to 40. I think now fighting for 30 is what we are doing. I think 40 may be a bit more challenging given the elevated credit cost. But having said that, like I said, for us, could we have hit our numbers of estimated PAT by growing unsecured book in the first half? Yes. But I think that would have been a very short-term decision. We decided not to grow because we wanted the environment to settle down, to clear up. If it does mean a quarter or two of lower profits, I still think so that is a better decision for the bank, which we have taken.
So there's some bit of margin pressure, right? Is that deposit driven? Where is that really coming from, and what do we expect, or what should we expect going ahead?
The reason for the margin compression is a drop in unsecured book. It's a high yield business. High yield business has gone negative. Instead of growing 2%, it's gone -7. So obviously, and with some increase in delinquency, so interest in suspense also has caused the challenge. Yet we are at 7.7%. We were at 8% in March. So it's not a huge drop. But yes, I think from 7.7, it should get better. Because as we keep stabilize unsecured, which means the growth rate will turn slightly positive, let's say in the second half. So obviously things will get better. Cost of deposit, I must tell you that we don't see it causing a challenge to us. And we don't see it growing from here. We actually see it slightly moderating downwards. And this is irrespective of any MPC decision, because we have actually cut our deposit rates from 1st of July. As you would read in the numbers, our deposit growth first half has grown 10%. Time deposit at 9%, CASA at 12%, total deposit at 10%. So which is a very healthy clip. We are not very, we are working hard at it, but we certainly would add another 10% is the way we look at it. And we are not increasing the cost as we go into second half. So I think NIM will get slightly better. I'm very quiet about whether 7.7 will go back to 8 or not. Because see, like I said, one quarter safety will give us longer term safety. I rather go with that attitude. If I find the answer, I will go for it. But if I think that unsecured has to remain slow or just stable and not grow at all, and that is the right answer for the bank, then we would even do that.
Guidance metrics spelled out do you believe that's how it will shape up?
Yes, I think very close in every aspect, Parsh, and rightly calculated also. And I must tell you that if you pass with that result, then I would think that, we are in the business where you will have ups and downs. But I would take that as a good result for us if we do end up achieving that.
All right. Mr. Kamal, thank you so much for taking the time out and all the best for the quarters ahead. The stock, unfortunately, down about 7% on that miss. But a stock which is doing very well is EPACK Durables. Now, of course, the announcement warrants this kind of a performance. They've entered into an agreement with a global leader in consumer electronics, Hisense, to manufacture air conditioners and home appliances in India for the world. Mr. Ajay Singhania, Managing Director and CEO of EPACK Durable, joins us right now on the show. Mr. Singhania, congratulations on this and thanks so much for joining in. Let me first get this. Actually, tell us a bit about this agreement that you signed. Let's start off with that.
Okay. So good morning, first of all. Thank you for letting me in. So this agreement what we signed with Hisense Global is around creating a manufacturing facility in India, a dedicated facility for Hisense, wherein we manufacture their air conditioners and other appliances like washing machines, going for refrigerators and the small domestic appliances, to be marketed within India as well as outside of India. So we are looking at both domestic and export opportunities herein for Hisense and their associated other brands. So the whole idea is that once we create the manufacturing dedicated facility for Hisense, which would be set up in Sri City, the technology, the tools, the designs, and the latest manufacturing capabilities will all be transferred to us by Hisense. So there will be a lot of strategic alignment in both setting up the facility, running the facility, and then manufacturing goods as per their design.
Mm-hmm. So Mr. Singhania, just spell it out for us. I heard you say that it's air conditioners, refrigerators, and other washing machines and other durables. So what is the nature of the deal? What is the size of the deal? And do you also manufacture for India, or it is only for the rest of the world?
So first of all, in terms of the size, in terms of investment, we're looking at investing close to 250 crores. So that's $30 million in phase one, setting up a facility for a capacity of 1 million air conditioners and almost 500,000 of washing machines. And this quantities we plan to achieve, Hisense plans to achieve by FY 27-28. So that's 3 years. The first set of production will be rolled out from June of next year. So that's in terms of the capacity and the investment. And in terms of top line, we're contemplating a top line of reaching at least $1 billion in the next 3 to 4 years. So the products manufactured would be sold both within India as well as outside India. Hisense is planning to launch their products in the India market in a big way. They already entered the India market 3 years ago, have been testing the waters, understanding the market, and now they feel they're very confident that they can actually capitalize on the growing economy and the growth in the market which we see for air conditioners and other products. So they look at India market in a big way, and then definitely the supply chain opportunities outside India are humongous. So it is for us the opportunities in both the directions.
No, sorry, I'm just trying to get this straight. I heard you say that you would invest 250 crore rupees. Is that right?
Correct.
And did I hear you say that you expect $1 billion of revenue from these capacities in FY 27-28?
No, not a single year. So we mean within 3 to 4 years, accumulated top line of $1 billion. So
what's the annual ROI for the full capacity? So let's assume in FY 27-28, if you're operating at full capacity, what is the revenue then you get from that? Any estimates?
See, the estimates in that sense would be quite difficult to do right now, but what we are seeing is 1 million sets of air conditioners and 500,000 of washing machines. So that probably gives the picture in a more correct way.
Yeah,
At the same.
No, but I'm saying that has a value as well, right? So is there a rough value of what 1 million pieces of air conditioners and 500,000 of washing machines add up to in terms of revenues, maybe roughly?
Roughly, that would be like, say, close to 2,500 odd crores.
2,500 odd crores. So, wow, okay. And this is the only, Mr. Singhania, just getting the numbers out of the way, is this the only investment that you need to do for the capacity, or do you need to incrementally add some more capex over the course of the next 2-3 years till the time the capacity comes up?
Yeah. So the beauty of the alignment is that this new facility would be manufacturing the finished products for them, whereas our current facilities would be utilized to supply a lot of components required for this manufacturing. So at the same time, our current facilities will be utilized to supply the moldings, the other parts which we already do. So it's like a two-way benefit for EPACK, wherein our current facilities get utilized and the new facility definitely also the finished product as per their design.
Yeah. Okay, I'm coming to that part, but just before that, Mr. Singhania, do you need to add any other capex aside of the 250 crores for the new facilities, or is 250 crores the only capex?
So that's the phase one of the capex. Going forward, as we ramp up more capacities, looking at the global pull, more investments will definitely be required. But this is not, I mean, this is just the starting point. We believe that there's a lot of potential to grow this beyond the capacities we are contemplating right now. Okay. So more lines would be definitely be added.
Okay, more lines will be added as well. Okay, and just last couple of questions, Mr. Singhania. One, is this deal that has been struck at similar margins and similar ratios that your other, the regular businesses, or is it higher or is it lower?
See, currently we estimate to achieve similar kind of margins, but on top of it, we look at gaining more from the deal in terms of the designs, the sourcing capabilities. So the supply chain benefits of Hisense being a global leader, their sourcing benefits will definitely translate to our current facilities as well. So I think that is something more important for us because it will help us rationalize our current investments also.
Got it. So Mr. Singhania, you ended March 2024 or FY24 with a top line of about 1420 crores, if I'm not wrong, right? That was the consolidated top line. With the growth that you envisage from this deal in your current capacities, plus the other work that you're doing, plus the new capacity coming on stream, as a result of this deal, are the targets for, let's say, what you do in FY27 or 28, are you reviewing them? What is the new realistic or aspirational revenue target that you're setting for yourself?
See, two things here. One, a couple of weeks ago or a couple of months ago, I already made an announcement that EPACK is looking to grow beyond 5,000 odd crores by FY27-28. So that's the kind of target we have in mind. And with this kind of a deal, we definitely are looking to surpass those numbers. So we definitely are on the right track. And such associations not only help us put India on the global roadmap, but also bring those technologies which will help us scale the production capabilities and manufacturing capabilities required currently, more urgently, the way the market is ramping up.
Mr. Singhania, I'm very happy for you, but I'm saying this 5,000 crores target was done or given keeping in mind the Hisense deal, because you would have some sense of that. And I heard you mention that you will surpass those targets. Will you just barely surpass those targets in FY27-28? Or do you reckon that there is a chance of a substantial improvement on that because of the Hisense deal?
I'll keep that open, but definitely we are looking at surpassing those numbers.
No, but even 5,100 is surpassing, even 6,000 is surpassing. I'm just trying to understand, is it barely surpassing or is it slightly better?
Surpassing substantially, definitely.
Substantially.
Okay. The market definitely seems to be in the right track.
You don't need any capital raise for the same, right? You are adequately funded, or do you need to raise some equity capital?
Currently, we're adequately funded.
Adequately funded. Okay. Well, very good deal. Remarkable. Congratulations, Mr. Singhania. Wishing you all the best for this.
Thank you so much. Thanks.
I don't know whether you were trying to corner him or he was.
No cornering. It's just see. It's a great deal for him.
Yeah.
Because at 1420 crores, Samina, March 24, they're talking of 5,000 crores. That's trebling revenues in 4 years. Let's say, right? Trebling revenues in 4 years, and this deal helps them surpass that, and it's done at the same margins. 250 crore of investment. He's saying he'll probably garner a top line of 2,500 crores. It's quite remarkable, this deal. No wonder the stock is locked on an upper circuit.
And I guess production, like he said, starts in Feb or March 2025. So it's a big facility that they're putting up. This is a big, big deal for the company, and of course opens up a whole global market share that they could potentially gain, not just over the next 3 years, but consistently grow as it goes along. But of course, It's getting closer to 10 a.m. and it's all eyes on Hyundai that will list in a few minutes from now. It's a mixed bag. The grey market, which was trading at a discount, has now finally moved to a premium this morning. Puneet is standing by with what should we expect, and then Astha joins in to talk to us about the listing itself. Puneet, first over to you.
Well, thanks for that. So, as you rightly said, the grey market premium has, got into the positive this morning. And the fact remains that it is India's largest IPO. So we have a couple of brokerage notes as well that's come in this morning before even the listing has happened. So we have Nomura. They have initiated coverage on the stock with a target price of roughly about 2,472 rupees per share. And that's almost a 20% upside from the current market levels. And what, the brokerage has been saying is very key, because they have said that, Hyundai has been able to predict, the consumer shift that happened towards, SUVs back in 2015 as well. So from just about 13% SUVs, it's moved to roughly 67% of SUVs now for the company. And they expect that the company is also poised for long-term growth with SUV mix of about 67%, with improving average selling prices, every year, as well as the improving market share of the company, currently around 14 to 15%, which is a number 2 player. They've also said that, having an Indian management over the last 2 decades has been one of the key things as well, and a key advantage for the company to adapt to the local market. And they are also best positioned in the passenger vehicle space to handle any kind of tech transition that might happen, which we have seen over the last decade as well. Now, they're estimating the company to deliver about 8% volume growth CAGR over the next couple of years until FY27, and that will be driven by 7 to 8 model launches in this particular time frame as well. They're also expecting that, for overall EBITDA margins will improve to 14% by FY27 versus 13.1 that it reported for FY24. We also had another positive brokerage note coming in from Macquarie this morning. They also have a buy with a target price of 2,235 rupees per share, 14% upside. And they have mentioned that, Hyundai's market share has been, in the compact and mid, SUV market has stabilized and will improve from year on as well, despite significant competition from the likes of Tata Motors as well as Mahindra and Mahindra. They've also mentioned that, they've outperformed its sister company Kia as well in this particular time frame with the models such as Sonet and Seltos for Kia. And they are also, Maruti is also currently facing risk. Lower market share, about 37% for YTD FY25 as well, because of model sharing with Toyota. They are anticipating that, over the last 5 years, it has, higher realizations compared to Maruti as well. And specifically, they mentioned that, over this particular time frame, that they believe Hyundai deserves a higher price to earning multiple when compared to Maruti Suzuki. That's also because of premium pricing and better models compared. So finally, what they expect, they're estimating a 12% PAT CAGR between FY25 and 27 for someone like a Hyundai, and also implying that roughly about 25 times price to earning for Hyundai, which is a 15% premium for Maruti versus compared to Maruti for FY27. So overall, a very largest IPO listing today. It'll be interesting of what it does to the other listed players as well, and how the strategy changes. Back to you.
Right, Puneet. Thank you very much. The world is watching. In fact, I saw a couple of the global headlines across global publications where it said that investors will be closely eyeing Hyundai as it lists on the exchanges today. Astha Jain, Senior Research Analyst of Hem Securities, are joined in. Astha, good morning. Thanks for joining in. Astha, what are we expecting? We've been swinging between losses on the grey market to gains this morning. Where are you anticipating the Hyundai stock to list at this morning?
Hi, good morning to all of you. So talking about this counter, first of all, what we have given as the recommendation was a subscribe from long-term point of view, not from the listing gain point of view. And there were a few factors that were behind those recommendations. First of all, we didn't like the valuation, because the valuation at which the company brought the IPO, we think that they have left nothing for the investor on the table. So that was not to our liking, and that's why we were not expecting any sort of a listing gain. Another point is that this is one of the biggest size IPO we have seen, and in the history we have always seen when such kind of biggest size IPO came, except Coal India, I think none of them have been able to garner any kind of listing gain premium. So that was another point which was really not allowing us to give it for the listing gain perspective. Now talking about this counter, what we feel for this listing, what I feel at this juncture of time, this listing may be at the issue price or something below than that, not much, because I've always been saying these to my clients on the various channels, that the kind of subscription which this IPO has garnered, only strong hands have put in their money into it because they know in case of any fall on the listing, then they will not come for selling. So these are the strong hand, and when some strong hand subscribe to the IPO, then the supply will be very less. This is what we believe. And I had this point in my mind at the time of IPO recommendation also. Maybe the supply crunch will be there, and that's why the issue will be able to maintain its IPO price or the issue price, as well as might be some discount can be seen, but not much premium. So now my idea here is the kind of momentum we are seeing in the market. In fact, the markets was also not good. When this IPO came, the market conditions were not good. And even we have seen Maruti has corrected a lot. So keeping all these things in mind, we have given it subscribe for long-term rating. Now, what we are expecting as a listing, we are expecting the listing to be somewhere at the issue price and minor lower than that. But I think in the later course of a business, I'm keeping my fingers crossed while I'm recommending this, but in the later course of the business, it should settle somewhere near the issue price or some more premium like that. So now what should one do who have not, applied in it? They should wait for some correction. Maybe 1840, 1850 is a good level to make an entry into the counter if at all it will come to those levels. And those who have already got the allocation, they should keep it in their long-term portfolio because after all, Hyundai is a brand. It is a number 3 company at the global level, and all big funds have they put in money into it. One thing which I want to draw your attention towards is that BlackRock and Fidelity, these are 2 funds that they never, and they come very, frequently, not they put their money into any big IPOs in the Indian market. So they come very less, and big funds have their interest into it because after all, it is a brand, and they have put in into Hyundai India, which is a looking after the Indian growth story. So I think this IPO will not fall much. I mean, the issue price, it will settle somewhere near the issue price or a minor dip can be there. But we are recommending to buy it at the lower end of around 1800 to 1850 odd levels.
Also, so the 1800 to 1850 levels is looking like a good entry point. The price discovery is underway, and it seems like the listing is going to be at a discount. 1931 is what we're expecting versus the listing, the subscription price band of 1965. While you're at it, Asta, so clearly don't expect listing gains. What you should do is look at the stock from a long-term structural strategic portfolio buy, and if you couldn't subscribe to it during the listing phase, today may be a good time to add to that stock is what Asta believes. Asta, while we have you, we still have 2 minutes to go before we hit the listing. A quick word on Waaree Energies. A phenomenal oversubscription on the very first day, both on Waaree and Deepak Builders. Quick view on that.
So we are recommending Waaree Energies because the kind of business they are into, it is very hot right now, manufacturing solar PV module cells. And the company is one of the biggest company into this space. In fact, few months back, Premier Energies IPO came. But this company is double the size in case of profitability I'm talking about, in case of the installments and the capacity installed they are having. So I think this is a very good IPO to invest the funds in. We are recommending it to for the listing gain as well as long-term purpose. Talking about Deepak Builder, it is a very small size IPO, and such kind of IPOs may garner some sort of listing gain. So we are recommending both the IPOs for the listing gain as well as long-term perspective. But our major choice or my first number choice is with Waaree Energies at any point of a time. So we are strongly recommending this counter.
One quick follow-up there, Asta, on Waaree. Let's say, what is the 2-year outlook like? I mean, you are sounding very constructive there. People are subscribing to the IPO. What should they watch out for? Listing gains or holding gains?
So, Niraj, as you know, most of the retail investors, they only look after listing gains.
Which is why I'm asking this, yeah.
Yes. So for those retail investors, if they really can wait for the long term, because some new capacity has been going to come within a year or 2. And I mean, these capacities are on a very good technology base that this company is coming into. So I think if they can wait, then definitely it will be a good long-term portfolio candidate also. So my idea is for the retail investor, book partial of it and keep the partial quantity in the long-term portfolio as well, because I think in the long term, it will yield strong returns.
So one final question, Asta. Circling back to Hyundai or Hyundai, however you want to pronounce it, but I'm calling it Hyundai. So circling back to Hyundai, would you believe that there are other auto companies which are better bets? I don't know if you track autos per se or only IPOs, but let's assume that you're looking at Hyundai versus its peers. Is Hyundai a better bet if it starts off lower today as it seems to be? Or are there other auto companies, four-wheelers, which are better bets?
So if anyone want to bet in only the passenger vehicle market, that is the car market,
Exactly.
is only Maruti. And I tell you one thing, these global funds, they are always looking for such kind of strong growth story which India is giving them. Otherwise, they would have put their money into the Hyundai global company also. But looking after the growth story of India, I think they have come into it. So I think we should give this also a chance. And if someone keep both the counters, that is Maruti as well as Hyundai in their portfolio, so they are almost getting 55% of the market share in the passenger vehicle market, because these two together constituting of around 55% market share. My idea is, so if anyone lose the share, then it will be the gain for others. These are number one and number two. So I think both these counters are looking good to us. And I'm not comparing it with the rest of the peers, because in the car makers, I think these are the two competitors. So I think one can look after Maruti also. So these two are such counters that one can keep both of them in their portfolio. After all, Hyundai is a brand and it is a global level brand. So I think everyone wants to keep such kind of auto company in their portfolio.
Thank you, Asta. Good talking to you. It is still the preferred bet is Maruti, but in a few seconds from now, Hyundai will be listing on the exchanges. The expectation is it should be getting listed at a small discount. But there's a good chance that investors who didn't get their hands on this IPO in the subscription phase may actually look at allocating incremental capital to the counter. So a good possibility that even if it gets a flat start, there could be a good chance that it may end the day on a positive note on back of buying action that could emerge in the day. It is now finally have listed peers to compete with directly, the likes of a Maruti, who do appear cheaper on a valuation front, and M&M, which promises stronger and better growth. But it's taken it 26 years to in India to finally hit the market. They're waiting to ring the bell, but as you can see, it's a good sort of diversified senior management of Hyundai. And as the street would have, okay, so there you go. It did start off negative and it's charting its way in a positive territory. Exactly what I thought it would do. This is not too bad. Flat start. The buying could come in over the next few hours. Investors who haven't got their hands on it may look at acquiring it. 1965 was the upper price band of the subscription. The opening is rather flat this morning, but not as bad as the 3-5-7% discount that we were or have been seeing in the grey market premium on the counter. Settling around 1940 is what we had. The much talked about 27,000 crore IPO that opened in the markets, the largest of our times, is what we have. Niraj, I don't actually know how to react to this.
Yeah, now slipping, Samina. Let's cut that audio out, but now slipping. Hyundai, 1.792%.
Let's also see what Maruti is doing while we're at it. Just if we can get also Maruti next to that or somewhere on the side, it'd be good to tell how the company is doing. There are positive brokerage reports and everyone's constructive on the stock from a long-term holding investment. No listing gains. There'll be a little disappointment, no, Niraj, for the 2.5 times oversubscription. I know that the retail participation was muted, and QIBs who have, of course, oversubscribed can't exit the stock anyway on listing day. So I guess there is no disappointment because retail participation was anyway muted, to say the least.
Yeah, so for retail, maybe not as much. Samina is absolutely right, and we'll get in Ajay Srivastava in moments from now to get his comments as well. But on Hyundai, as Puneet mentioned, like for example today, we've gotten a note from Nomura as well as from, I think, Macquarie, if I'm not wrong. And they have said that they have initiating this with an outperform rating and in the target price of 2235, which implies a 14% upside to the issue price at the upper end. It's not moving thus far, Hyundai, in any fashion whatsoever towards those prices. It's a large IPO. You would argue a successful IPO because it's gotten subscribed all well. Now let's wait and watch over the course of the next 12 months. Does it do better or no, Samina? Any guesses?
I think it'll, a year out, I think the price, actually this is such a tough one because it's not coming at a deep discount, right? It's coming fairly well priced, but there is a good possibility a year out the stock will be trading higher than its issue price, but only because the growth trajectory looks strong. Electric vehicles is the big play, and in the last couple, and they also have very healthy margins. So industry-wise, their margins are healthier than its peers, even though there has been a slight decline of the auto majors, including Maruti and Hyundai, in terms of market share. But very aggressive expansion plans. They're sitting on 15,000 crores of cash, which will be invested in new sort of innovation in that sense. Ajay Srivastava, do we have him ready to get a quick view on it? Ajay, good morning. I'm going to sort of barge into your talking point conversation with Niraj and have you a quick question with you on Hyundai's listing. Do you think the price on Hyundai 1 year out will be higher than its listing price today?
I don't think so. And the only reason it might get higher in the middle is because there's no retail participation. So you will find some HNIs, some portfolio balancers coming in to buy it. But I do not believe that this price should be higher 1 year down the line, given what economics are. And given the way it's been a pure just OFS at the end of the day. It's not the money going to the company to set up a new plant, expand anything. So, and number three, that if you look at the philosophy of the investor, they pulled out the dividend right before the IPO. All the cash already, 40% of cash was pulled out at that point of time. But it tells you the continuing philosophy that's going to happen is that this is going to be bleeded out for the parent at the end of the day. That's what's going to be. They've just used it to list the company, take the money out at the end of the day because we have a higher premium in the market. It's not that the money was kept here to grow the company, buy ancillaries, build businesses here. It's going to be a continuous process of money out to support the parent company. So I think investors will want to say, initially there may be some amount of upside because nobody owns it in retail and HNIs and so on. But eventually it'll come back to toil and see what happens with promoters and companies like this who just encash the market and walk away with the money.
Okay, point well noted. Ajay. Ajay, stay on.
Good morning, Nish.
Yeah, good morning. We need to slip into a break, in fact, wrap up India Market Open. But talking point today is with Ajay Srivastava. Stay tuned. We'll be right back.